In the world of finance, understanding a company's financial health is crucial for investors and business owners alike. Two key concepts that provide valuable insights are the weighted average cost of capital, or WACC, and free cash flow, or FCF. Think of them as vital signs like a company's pulse and blood pressure. WACC tells us how much it costs a company to raise funds, while FCF reveals how much cash a company has left over after covering its essential expenses. Together, they paint a comprehensive picture of a company's financial well-being and potential for growth. Okay, let's dive into the intricacies of WACC and FCF, breaking down their components, calculations, and significance in financial decision-making. By the end, you'll have a solid understanding of these crucial metrics and why they matter. Whether you're a seasoned investor or a curious beginner, understanding WACC and FCF will equip you with valuable knowledge to navigate the complex world of finance. Imagine you're running a business. You need money to operate, to pay your employees, buy inventory, invest in equipment, and more. This money comes from various sources, like loans from banks, which we call debt, and investments from shareholders, known as equity. The weighted average cost of capital, or WACC, tells you the average cost of raising this money. It represents the minimum return a company needs to earn on its investments to satisfy its investors and creditors. A lower WACC indicates a company can raise capital at a lower cost, making it more attractive to investors. Conversely, a higher WACC suggests the company faces a higher cost of capital, potentially making it less appealing. Understanding a company's WACC is crucial for evaluating its financial health and its ability to generate value for its stakeholders. To understand WACC, let's break down its components: equity and debt. Equity refers to the funds invested in a company by its shareholders, while debt represents the money borrowed by the company. Each source of funding comes with a cost. The cost of equity is the return shareholders expect for investing their money in the company. It takes into account the risk associated with the investment. The cost of debt is the interest rate a company pays on its borrowed funds. Both the cost of equity and the cost of debt are weighted according to their proportion in the company's capital structure. This means that if a company relies more heavily on debt financing, its WACC will be more influenced by the cost of debt. Calculating WACC involves a specific formula that considers the cost of equity, cost of debt, and their respective weights in the company's capital structure. Let's illustrate with an example. Say Company A has a capital structure composed of 60% equity and 40% debt. The cost of equity is 10%, and the cost of debt is 5%. The corporate tax rate is 30%. Using the WACC formula, we can calculate Company A's WACC as follows. WACC equals the proportion of equity times the cost of equity, plus the proportion of debt times the cost of debt times 1 minus the corporate tax rate. Plugging in the numbers from our example, WACC equals 0.6 times 0.10 plus 0.4 times 0.05 times 1 minus 0.30, which equals 0.074 or 7.4%. This means Company A's WACC is 7.4%. In other words, the company needs to earn at least a 7.4% return on its investments to satisfy its investors and creditors. Section 5. Free cash flow, or FCF, represents the cash a company has left over after paying for its operating expenses and capital expenditures. Think of it as the cash a company is free to use for other purposes, such as paying dividends, reducing debt, or reinvesting in the business. A healthy FCF is crucial for a company's long-term sustainability and growth. FCF is a measure of a company's profitability that takes into account its investments in its operations. It provides a clearer picture of a company's financial health than net income alone, which doesn't consider these investments. Investors and analysts closely scrutinize FCF as it reveals a company's ability to generate cash and create value for its shareholders. Section 6. Components of FCF. Where does the money come from and go? To understand how FCF is calculated, let's break down its components. The starting point is a company's operating cash flow, which represents the cash generated from its core business operations. This includes cash received from customers and cash paid to suppliers and employees. From the operating cash flow, we subtract capital expenditures, which are investments in fixed assets, like property, plant, and equipment. These investments are essential for a company's long-term growth, but are not reflected in operating expenses. The remaining amount after subtracting capital expenditures is the company's free cash flow. Section 7, Calculating FCF. Putting the pieces together, calculating FCF involves a simple formula. FCF equals operating cash flow minus capital expenditures. Let's illustrate with an example. Company B generated $100 million in operating cash flow last year and spent $20 million on capital expenditures. Using the FCF formula, we can calculate Company B's FCF as follows. FCF equals $100 million minus $20 million, which equals $80 million. This means Company B had $80 million in free cash flow last year. This cash can be used for various purposes, such as paying dividends, repurchasing stock, paying down debt, or reinvesting in the business. Section 8, WACC and FCF, a powerful duo in financial decision-making. WACC and FCF are essential tools for making informed financial decisions. Companies use WACC to evaluate the feasibility of new projects and investments. For a project to be considered worthwhile, its expected return on investment should exceed the company's WACC. FCF, on the other hand, plays a vital role in valuing companies and making investment decisions. Investors use FCF to assess a company's ability to generate cash and create value for its shareholders. They use various valuation models that rely heavily on FCF projections to estimate a company's intrinsic value. Section 9. Conclusion. WACC and FCF, essential tools for financial health. In conclusion, WACC and FCF are indispensable concepts in finance. WACC tells us the cost of capital for a company, while FCF measures its ability to generate cash after covering its essential expenses. Understanding these metrics is crucial for investors, analysts, and business owners alike. By analyzing WACC and FCF, stakeholders can gain valuable insights into a company's financial health, its ability to generate value, and its potential for future growth. These metrics are essential tools for making informed investment decisions and ensuring the long-term sustainability of a business.